Welcome to our October webinar with Brandt Brereton of Perpetuate Capital. We're so glad to have you here. I see a couple of folks that have introduced themselves already in our chat. Please go ahead and do that. We'd love to have that opportunity to build some relationship, make some connections here today, and in that way continue to grow the kingdom. So welcome to Duncan, Joanne, Steve. Great to have you here. Thanks so much for being here with us and looking forward to our time together. Well, we had the absolute pleasure of enjoying time with Brandt at the FCCI conference in Lake Tahoe last month. We're thrilled to dive deeper into some of Brandt's expertise here today, expertise that is far and beyond me, and I'm so thankful that we have people like him who can dig into some of these wonderful topics and help bring some clarity and give us some wonderful opportunities to understand better how we can engage in the redemptive work that God's called us to do through some of these funding options, and so we're looking forward to that. Before we jump into our webinar, just a couple of quick announcements, one being that chat option, and let me just pull that up and just give you that quick reminder again that we do want you to introduce yourself and to submit some questions as well in the chat so we can pull those up for some Q&A at the as we wrap things up here today, and a chance for you to engage with Brandt, so please do that. And then also, if you haven't been listening to our podcast, I want to encourage you to do that. We release a new weekly podcast episode every Monday morning at 5 a.m. Eastern Time. This week, Leading with Honor from Colonel Lee Ellis. Just an absolutely amazing story and great content there. You don't want to miss that. Going back a little bit there, even episode 80, I know that's small on your screen, but Principles of Decision Making with Bob Beal is some absolutely incredible content that I've been enjoying with some of the groups that I facilitate here at FCCI in recent weeks, and I know you'll gain a lot from that. So make sure you take advantage of our podcast, and we'll be thrilled to continue to bring that to you on a weekly basis. Well, next month in November, our our guest will be Dwayne Donner of Founders Advisors, and we're so grateful for Dwayne's involvement here at FCCI, serving on the board, and thankful for how God continues to work and move in his life. One of the opportunities that God called him to develop many years ago now is the Heritage Forum, which is actually going on right now. And I'm so thankful for the fact that he and other key leaders are just pouring into the lives of others, encouraging them to look at God's calling in their life and understand how to map out a plan that's going to be effective for their family, for their legacy as they move forward. So Dwayne's going to bring to us a topic and conversation there in November. Perfect timing, just before Thanksgiving, when families get together and maybe help navigate some of those family conversations. So really looking forward to that time with Dwayne. So don't miss that on the 19th at 1 o'clock. We'll have the registration opportunity for you in the email that will come out to you immediately following today's webinar. Well, before I bring in Brandt, I wanted to just read from Proverbs 11 very quickly. Proverbs 11 verse 10, just a great reminder that I believe ties in so beautifully to this topic today. And in Proverbs 11 verse 10, we read, "When the righteous do well, the city rejoices. When the wicked perish, there is joy. The city is exalted by the blessing provided from the upright." And that the word for righteous there, I learned recently, the word is sadiqim, which the Hebrew word there, and really speaks to those who are following in the way of the Lord, those who are honoring him with their lives, and the fact that when the righteous are doing well, that there is benefit to everyone else in the city. And so the city rejoices when the righteous flourish, when we see that kingdom flourishing taking place. And so looking forward to this conversation. And Brandt, so great to have you with us. Thanks so much for joining us here today and being able to help us continue to navigate what are some ways that we can truly see that flourishing happening as we impact the lives of others within our company. So great to have you, Brandt.
Well, thank you, Ken. It's wonderful to be with you guys. I'm very gratified.
And I understand that it wasn't too long ago that you actually moved to the Lake Tahoe area after we just had some time there. But
Yes, that's right. Yeah, I grew up in San Jose, California, back when it was cherry orchards in the 60s and 70s, and it rapidly became the epicenter for technology and the epicenter for insanity, I would say, in the last decade. And so it took about 5 years to negotiate with my wife, who was taking care of my mother-in-law in her 90s, to
Wow.
finally tap out of California. So I wasn't one of the early movers out of California, unfortunately, but I can't tell you how happy I am to be sitting in the mountains, it's snow tomorrow and breathing the
Ah,
fresh air. It's wonderful.
so I know you enjoy fly fishing. Now, is fly fishing season's coming to coming to a close then, huh?
Oh yeah. Well, the steelhead fishing is just getting
Ah,
started.
there
So
we
yeah,
go.
it's kind of a year-round passion of mine. So
Oh, fun
blessed to
times.
be able to spend once a week hip deep in the river.
That's great. I
Edison.
love it. Well, I know that's one of your passions. Tell us about why you do what you do here, though, as far as the work that you do through your business.
Yeah, I'll be stealing a little bit of thunder from probably my first slide, um, but in fact, I just wrote a book that's about to launch in January. So you guys will all get copies of the book that kind of addresses this issue. But I've been so been in investment banking since I was a kid in 1987, and been selling privately held companies to public companies and private equity groups for almost 40 years,
Wow.
and um, both Christian companies and non-Christian companies, and
Mm-hmm.
increasingly over the last 10, 15 years, because of sort of a grounding by the Lord, just heartbroken when I see Christian-led companies where ministry is happening in the business on some level. Ministry is happening outside of the business because of the profitability of the business. You see these companies sell to secular private equity groups, and that ministry just dies. And
Mm-hmm.
we all have, I think, holy ambitions, to steal a phrase from my former pastor, Chip Ingram, that God puts on your heart, that we need to do something about this, and sort of a Nehemiah-esque
Mm-hmm.
calling on trying to step in the gap and solve that problem. Really,
I
very
love that.
passionate.
Yeah.
People will accuse me of being overly passionate about that for sure.
I'm so glad you are because it is so critical. And thanks for mentioning Chip Ingram and that. I know that our family here at FCCI has been so blessed by some of his teaching through the years, and I'm just so thankful for that. And so yeah, glad for that background experience for you as well. And so I want to just mention real quick, if we could, folks, yeah, just in that chat, do submit those questions as we dive in. And Brandt, I'll let you go ahead and pull up your presentation and have that
Sure.
ready to fire away here as we turn things over to you and dive in here for the next little bit. And looking forward to what you're going to bring to us. So with that, Brandt, I'll go ahead and just turn things over and let you take it from here. Thanks so much.
Great. You're seeing the slide, okay? Ken, are you seeing this?
Yes, we've got that. So you're in good shape. Let me just
Okay,
there
good
we go.
deal. That worked. Okay. So I'm gonna hit 4 slides today, and I'm gonna try to keep those 4 slides comments to less than 30 minutes. Blast through it pretty quickly. There's always a lot of Q&A on the back end of this, and so I want to make sure that we leave ample time for that. I'll begin, I think, by saying that, and many of you already know this, that Billy Graham, before he died, said that he believed that the next great revival in America was not going to be in the church; it was going to be in the marketplace. And I don't think we're there yet, but there's a lot of really, really positive signs. There's when I look at all of the FCCI companies, the Convene companies, the C12 companies, and other Christian-led companies that maybe are not yet part of a CEO forum, there literally are going to be hundreds and thousands of faces of people that we will see in heaven when we get there, that are there because of where they worked. they were disinclined to go to church for whatever reason, and they happened to work at a company where the leadership integrated their faith into the business. And so it is a very, very powerful dynamic that is happening in America. Hundreds of millions of dollars, about $1 billion almost, comes out of the profits of these businesses into ministries because of the profitability of these businesses. And so, as I mentioned, it's just tragic to see these companies sell out to secular private equity groups because they don't know that there's a better way, better alternative. And prior to the last 18 months, there really wasn't a better way. And so part of this message is that there's really, really good news, because of some innovations that my partners and I have taken with a unique structure. And so, that's the really, really good news. Here's the bad news. This is a graph of the baby boomer retirement wave that many of us have heard about or seen in the press. And we're about right here, right? 2024. And so still probably, another 30, 40 million Americans are going to turn 65 in the next 20, 30 years. And many of, just to kind of connect the dots, I mean, many of you and me and the Christian businesses that are salt and light in America are owned by guys and gals our age. And we need to usually that the business is the biggest asset in their personal net worth. It's illiquid. And there's a very legitimate need to provide liquidity for that asset for wives, children, grandchildren, heirs. And so, again, just too many people are selling out to private equity groups, and it's a trend that's going to continue. This is when I started. I literally started in investment banking in the crash, the first day of work, crash of '87. So explains the gray hair at age 60. And this is the number of private equity groups that have been formed in America since then. And so that upper right corner, I think there were about 11 or 12,000 of them in America, which is way too many. Just this explosion of private capital aimed at buying these businesses owned by this demographic segment of America. And it's big, big business. And the problem is obvious. And so, it used to be that you had to be a saint in order to do the alternatives. So if you think about what the alternatives are, you can sell the company to a public company or the company that's at your industry association meeting every year bugging you about when you want to sell the company, or you can sell to any number of these tens of thousands of private equity groups, or the path less traveled is selling to an ESOP, employee stock ownership plan, employee stock ownership trust. Comes with a lot of misconceptions that I'm going to dispel in one of these slides. And so please don't turn off. Listen to the new innovations that have happened here in the ESOP market, in the private capital markets, because it's a whole new game, a whole new alternative, really. And so you used to have to be a saint to sell to the ESOP, because, and what I mean by that is that you get the same valuation that you could sell the business for to a third party, but you couldn't get the same amount of cash at closing. You had to wait to get more capital over time. Well, now that Perpetuate Capital has raised its fund, is in existence, and is praying to the Lord, show us what companies you want us to perpetuate the independence and the kingdom impact of. Now there's a better alternative. And so the essence of what we do is structure this alternative transaction where you're selling to an employee trust and getting now the same dollars, the same liquidity, the same cash on the barrelhead that you would receive if you sold to a private equity group, secular or non-secular. And so it really is a game changer. And so the best way to illustrate this is to show you what a side-by-side comparison looks like. So this is an example of a 5 million EBITDA business valued at 6x EBITDA, so $30 million, national average tax rates. And so when you sell to a private equity group, generally speaking, they're always going to want you to roll, quote unquote, roll over equity of at least 20%. So they're going to buy assets, first of all, not your stock. When they buy assets, it's less tax efficient for you, but way better for them legally and from a tax perspective. And so this is an 80% asset sale. So $24 million purchase price. This is a generalization of having done dozens of these over the course of time. Every deal's different, but this is a pretty good generalization. So maybe the business is valued at $30 million. You're going to get $24 million purchase price. 20 million of that is going to be cash. So 10 million is the buyer leveraging borrowing against your assets in your P&L, and then them coming out of pocket with an additional $10 million to equal the 20, and then a $4 million seller note or earnout or some contingent component to the purchase consideration to get to that 24. The equity that's been rolled over in this example, the 20% of the stock rolled over into the new company is your equity upside in the business, which could be worth 10 times the value that you rolled it over at, or it could be worth zero. Who knows? Depends on execution. And so taxes in a general typical deal like this maybe is $8.4 million. And so the total cash at close after tax and that typical private equity sale is $13 million, let's say. And I focus on total cash at close because that's almost always where you're focused. What you care about, and at the end of the day, when you look at all these letters of intent and term sheets, is how much cash am I going to get after tax on the barrelhead? Everything else might happen, might not. What's my guarantee? And so that's why I kind of level set at that number. And it used to be in the traditional ESOP sale. So back when you had to be a saint to do the ESOP sale, and there's plenty of saints as past clients and great success stories to hear from them. Same $30 million business, you're selling 100% of the business to the ESOP. It's a stock sale, so it's more efficient if you choose to pay taxes. And you're only going to get 10 million cash at close because there's no third party investor that is writing a check into that transaction. You're doing the transaction yourself with help, obviously, from advisors like us, but you're doing the transaction yourself. And so that same $10 million that the outside buyer could borrow against your company, you do the same thing. And then you're carrying back a seller note for $20 million, getting to the $30 million in purchase price. So you're not getting this much cash up front. You're getting more you're getting the same amount of money, but you're getting it out over time. And there's this notion called warrants, basically like think of it like stock options to keep it simple. So equity upside that is retained in the business after you sell it. And many of you are familiar in real estate with 1031, where if you 1031 having sold real estate, and you buy another piece of real estate, you can avoid the capital gains tax by electing 1031. A few paragraphs farther down in the code is 1042, which says that if you sell your stock to an ESOP and within 12 months, you reinvest those sale proceeds into US stocks and bonds, you get the same treatment. So you can avoid paying capital gains tax on the sale proceeds. And many, not all, but many companies will do this. Sellers will do this. And so that 10 million in cash that you got is tax free. Even though you've got another 20 million coming in over time, we're just looking at the $10 million in cash after tax that you get on the barrelhead when you do that transaction. And it's less than what you could get if you sold to an outside buyer, private equity group. So many people, as you might imagine, sell to the private equity group because they're focused on maximizing the cash at close. Now, with the advent of Perpetuate Capital, its new fund that launched this year, that's that same 100% sale to ESOP transaction is $30 million. Now the cash is 20 million, just like the private equity group could do. So we're borrowing 10 million off the balance sheet for yourself. And then our fund, just like the private equity fund, is going to write a check for 10 million. And so now you're getting the same amount of cash at close that you would get selling to a private equity group that we all know is going to kill. They're going to tell you what you want to hear, and they're going to kill the ministry. And so you're only carrying back a seller note for 10 million at that point. There's more equity upside that can be shared with everybody, including senior management and new CEOs, new senior management that can be brought into the business to solve for succession. You don't have to look internal only to solve that. And so now that $20 million, electing 1042, $20 million cash at close, tax-free, compared to 13, where you give up control and kingdom impact, is a complete game changer. And so that's kind of really the good news to share. I always get asked, if this is such a great deal, how come more people don't do this? I mean, every time I get asked that question. And so you guys, or some of you are old enough to remember David Letterman's top 10 list on TV at night. This is Brandt Brereton's top 10 list. So these are the top 10 reasons why tongue in cheek, I say you should not consider selling to the ESOP. And they're all false, by the way. So, people say I can't sell for market price. I have to sell for a discount. Not true. The ESOP cannot pay more than fair market value. So it can match offers from outside buyers. So people are very pleasantly surprised by the valuation that they can achieve selling to an ESOP. Employee trusts are just too complicated. Maybe. I remember the first day in high school that I walked into algebra, and I said the same thing. Algebra was too complicated, too confusing. But a week later, 2 weeks later, after I spent, 8 hours studying the subject, it wasn't complicated anymore. So things that you don't understand are always complicated until you take the time to understand them. And I think you'll see in this presentation that from a financial perspective and from a stewardship perspective, there are many, many reasons to invest 5 to 6 hours of studying algebra to kind of understand it a little bit better. Takes too long to get all the cash from the sale proceeds. I can't. I need to get more cash at close, and the only alternative is to go to a third party. That was true. It's no longer true. I don't want to sell my business to the employees who don't know how to run it and they don't have the money. Nothing could be farther from the truth. So you know how we put our assets, our personal assets, in a family trust, and our spouse and we are the trustees, and our kids and our grandkids and great grandkids are the beneficiaries of that trust. That is exactly the way that the ESOP, employee stock ownership trust, works. The employees don't have to have any money. They don't even have a say in whether you choose to bless them with this wealth. They just continue to work for the business, and they will slowly vest into becoming not shareholders. They never actually own the stock or hold the stock or vote the stock, but they slowly vest into becoming beneficiaries of the dollar value of the stock that you sold at fair market value to the trust. And so, biggest misconception of all, point number 4, that always needs to be clarified. And they don't have any enhanced say in the business or how to run the business. None of that exists unless you want them to have that, in which case you can, but that is not how this works and how it's set up. This is another very common misconception. I don't have a successor leader within the company. Common. You don't have to. That same fact exists when you're talking to the private equity group buyer, right? They have a bench of talent that they intend to drop in to be the successor CEO, be the successor CFO, etc., of the business. We collectively can do the exact same thing. So if you don't have the heir apparent inside the business, it's not a reason to not consider this alternative. We go do an executive search. We do the exact same thing that the private equity group is going to do to solve the problem that you have. So easily solved. We kind of hit on this before. I'm not going to give the employees a greater say in how they run the business. That is, they have no enhanced say or rights at all in terms of how the business runs exactly the same way going forward. Maintain your working capital, fund your capital budget, grow the business the way that you would normally grow the business. It's just that those excess profits that everybody's taking distributions on in order to pay the taxes, which bleeds, 30 to 50% of your profits away every year, stops. Taxation on the earnings, the profitability of the business, once you do this transaction, stops entirely, and it stops permanently. So every dollar of profit that is generated in the business after the sale to the ESOP stays in the enterprise and is available to service capital and service anything else. And I know I'm going to get questions on this in the Q&A time, so we'll tackle the details of that in Q&A. So the business operates normally, and you get to retain control of the board for as long as you want, irrespective of how much stock you've sold, including 100% of your stock sold to the ESOP, which is central to this strategy. I don't want to share the financials with the employees and show them how much money we make. You don't have to. The only thing that the employees see, so most of you have a 401k plan or some kind of a profit sharing plan, and they have a portal, or they see a statement of what the value of that plan, the plan assets are for themselves. Same thing would exist here. All they see is I have vested into X number of shares from an accounting perspective only, and the share price is Y dollars, equaling Z total dollars. That's all they see. Nobody sees financials. My company isn't big enough to consider that, this alternative. It's a very common answer. And it's pretty true, actually, because you kind of need to be, 2 to 3 million of EBITDA, at least 25, 30 employees to kind of be in the strike zone of the ESOP alternative. But again, an innovation that we have made is we look around like within FCCI, there could be 3 companies in the same industry different parts of the country, maybe they're each doing 1 million of EBITDA. So on their own, they're too small to kind of do an ESOP themselves. But if they locked arms and they wanted to sort of merge together, and all three of them sell to the ESOP at the same time in a roll up, and an ESOP structured roll up with our capital, they would do way better together on every level than what they could do on their own. So there's a new innovation that we could talk about for smaller companies, but it requires at least 2, 3 others uh, to join you if you're below 2 million of EBITDA. By the way, so these transactions are too expensive and too many regulations. I used to say the exact same thing. For the first 20 years of my career, before I did the deep dive and really became passionate about this structure, I had not studied it. People that say this, including myself, for the first 20 years of my career, so I'm guilty. We say it because of human nature. When you haven't studied something and you get asked a question by a client that you should know the answer to, and you're embarrassed that you don't, you obfuscate. You muddy the waters to make it look like the waters are deep, and it's what we do because we don't want to say that we don't know. But the reality of this is that the costs of selling to an ESOP compared to selling to a third party with an investment banker running the process to third parties, it's half. So the all-in cost to everybody, including lawyers, is about half the cost of selling to a third party in a managed sale process. And with respect to regulations, they're in no way overbearing. Excuse me. Excuse me. Um, Oftentimes people are not interested in liquidity. They're interested in growth capital. And it is possible, and we're very excited about showing people how to do this, to go into the ESOP structure, stop your taxation, and receive capital to grow the business. Traditional growth, do acquisitions, however you want to use that growth capital, but there's a much better way to receive growth capital and retain control of the business indefinitely. And so maybe I'll leave that. I guess I'll leave that up because that will stimulate a ton of questions, I suppose. But that's the meat and potatoes of kind of what I wanted to present, Ken. And I don't know where we are time wise, but would love to fill the remaining time with Q&A.
It's great, and I appreciate giving us some of that clarity because there's so much in there that all of a sudden it's like, oh wow, boy, the fog just cleared. So thank you for that. I appreciate that. Maybe kick us off here with giving us the difference between a management buyout and an ESOP. What are we talking about there?
Yeah, it's a great question. An MBO, a management buyout, is a different animal compared to an ESOP, and they often get confused. And so in an MBO, usually senior management is interested in buying control of the company from the owners, current owners, the sellers, and they indeed have to come up with financing and money out of their own pocket
Okay.
to buy the company. And so most management teams do not have enough money to do that. And so it's a very rare occurrence, actually, for that to happen. Almost always, management will get this idea. They'll go talk to banks to figure out what kind of lending can augment their equity investment in buying the business. And almost always, they have to go partner with a private equity group that will come in. And so it effectively, I don't care how you slice it, it's a private equity transaction. It's just that the management took the lead on it, and the extent to which they they come up with their own money, they're going to get
Hmm.
equity ownership over and above what they would sort of, vest into in a
Hmm.
normal transaction. So
Yeah.
they're not all that common, and they are not tax efficient at all.
Okay.
Um,
Well, you'd mentioned the taxation that it stops permanently, and maybe to dig into that a little bit more. So, can you give us a little
yeah,
more clarity around that and how that
yeah.
transpires? And yeah,
Everybody's eyes go like this when I do when I
right.
write Zooms and I
I
say
don't
that
have
and
to
they're
pay
like,
taxes. Great, thanks.
pathetic. Then they start shaking their head like this guy's crazy. How could that be? Most of you are LLCs or S corporations. Some of you are Cs, but most of you are flow-through
Hmm.
entities. Flow-through entities, an S corp or an LLC, we know does not pay taxes. The profits flow through to the individual shareholders, and those profits, that taxable income, is paid. The taxes are paid at the individual shareholder level. Okay. And so what we would have, we do this transaction, what we would have at the end of the next day is you'd have an S corporation. If you sold all of the stock, that has one shareholder now, and that shareholder is a retirement plan
Hmm.
in a corporate finance trust called an employee stock ownership plan, employee stock ownership trust. Retirement plans don't pay taxes. So that is how thousands of companies in America for the last 40 years have literally turned the taxation dial off with respect to the earnings engine that is the corporation. And so when you do that, so that's legally how
Hmm.
these companies exist. And a lot of charitable giving and ministry giving can be turbocharged
Right.
through this
Just.
structure that you're
Hmm.
continuing to control the board, control the company for as long as you want. So literally money that was flushed down the toilet in
Right.
tax given to the government to spend how they want to spend it, you can decide how you're going to deflect those profits into the charities and ministries that are most important to you.
That is fantastic. I love it. Let me just pop up a question that came in here because I think it's going to tie into that. Just the fact that, let's see, here we go, Duncan. Great question. Will this work in Canada?
No,
Okay. Sorry,
that's the,
Duncan.
that's the short answer. There's a variant of on this called an employee ownership trust in
Hmm.
Canada that where you can affect the control and deflecting profit sharing
Hmm.
to employees, though not beneficial equity ownership in under Canadian laws, but ESOP, American style capitalistic ESOP laws
Hmm.
do not exist in Canada.
Yeah. Okay. Good clarity there. Thanks for asking that, Duncan. And I'm going to pop up another here question coming in from Josh Adams. Does this type of structure work for professional services businesses, even though there are no assets for a service or a consulting business?
Great question. Interestingly, the second biggest, if you looked at all the companies that ever do ESOPs, banks, commercial banks actually is the
Hmm.
biggest segment, privately held
Hmm.
banks. The second biggest segment are professional services companies. And the
Hmm.
reason why is because most professional services companies indeed don't have asset laden balance sheets that a third party buyer can come in and say, I'm gonna pay you
Hmm.
$100, borrow $60 against your assets and come up with 30 or 40 myself. It's harder to sell private professional services businesses, and as a result, they they have embraced this structure in a
Hmm.
very, very meaningful way. Most people don't know this, but um, some pretty notable professional services companies are ESOP owned companies. So,
Hmm.
um, Boston Consulting Group is one. Um, Bain, another
Hmm.
one. Two of the three biggest, like white shoe
Mm-hmm.
management consulting practices are indeed ESOP companies.
Oh.
And Grant Thornton, I think it was the number 5 or 6 size CPA firm in America, last year did sold it to an ESOP. My friend did the transaction. So increasingly, especially as tax rates
Mm-hmm.
start to go up or look like they're going to go up and get really really punitive, really smart money, smart people are
How to make that.
dusting off the book and understanding
Yeah.
how these things can be used.
Okay, so that leads beautifully into just kind of a maybe give us some understanding of what are the next steps in this exploration process. If someone is saying, "Hey, yeah, it's time to take a look at that."
Yeah, so it's a multi-phase. Let's call it a three-phase process. The first thing that has to happen is you need to learn more, right? We need to learn more too. We don't. We're. I'm dealing in generics and concepts at this point, and I can teach pretty well conceptually, but there's nothing like seeing your own company's data in an analysis that's actionable, that kind of really
Mm,
tighten the focus on understanding. And so process wise, there's usually like an hour Zoom call where we'll do a deeper dive on like an illustrative example conceptually of how this whole thing works, and it will flush out even more Q&A than what we'll
mm,
have today. No, there's no cost for that. It's just purely educational. And then on the back end of that call, we'll show you a redacted sample of our
ah,
first step
mm,
analysis. So like, here's a sample of a valuation and a transaction feasibility analysis. So let's look at the last 5 years of the business. Let's look at the current snapshot of the business, and let's look at the projected 5 years of the business, establish a valuation range, and then show one or two or maybe even three different scenarios of using the ESOP to solve for whatever you're trying to solve for. So implicit in all of this is just maximum optionality. I mean,
mm,
it's very, very flexible. So to kind of show, and then when we present those findings, we want everybody that you trust as your advisor in the room, seeing seeing it for the first time, hearing it for the first time. So you have the collective brain power of everybody that you
mm,
trust hearing it and asking questions. And so it's an educational session. That's a pretty 30 days. And so that
mm,
so
mm,
that's kind of this pre-transaction guidance um, phase of the transactions. As you can see, it's not crazy expensive. And then after that, you are in a position to pray in a much more informed way
right.
about what you think you should do
Mm-hmm.
with the business. And when we're always sort of saying, here's the ESOP alternative, here's what your very viable private equity alternative is, so that because you need to
Mm-hmm.
contextually understand this alternative compared to what you can go do outside of it. And so it's very contextual analysis. And then if you decide that you wanted to proceed and go to execution, it's a second phase. And so normally these transactions are getting done in 3 to 5 months, so much shorter period of time
Mm,
where they're closed. And then there's we always provide like a 80 hour, or I'm sorry, 40 hours of unbilled consulting time post close to stay with
yeah,
everybody
sure.
going forward.
As
And
they're
so,
processing, yeah. Okay.
and nobody's ever used all 40 hours. So I
Mm-hmm.
can make it, it'd be fine.
Let me pop up another question here. This again coming from Josh, but different question. Here we go. Thinking about the benefits of partnering with a PE firm or other operating partners, some of the incentive to sell is leveraging those relationships and attract and retain new clients. And he had a follow-up question with that of just, will a potential firm gain those type of relationships, that kind of expertise, as they would from a PE firm?
That's a great question, and I think you're going to love my answer. Um, so for nearly 40 years, I've sold all kinds of companies to private equity groups and ESOPs and publicly traded buyers. And the biggest blind spot that business owners have is knowing when to consider a private equity transaction. And so if you look at, I'm going to get quantitative for a second, but it's reality. If you look at all the private equity groups as an asset class and how they have performed in terms of generating a return to their investors, like it's a bell curve, as you might imagine. The last 15% of that right side of the curve are the private equity groups that have outperformed all of their peers. They're the ones that are just crushing it. What is common about those private equity groups that are crushing it? It is this fact. Those private equity investors, the general partners in those funds, hail from a certain industry where they were operators and they were very successful operators in that industry. And now they are private equity investors in that industry. And that private equity fund is focused on that industry from a private equity investment perspective. So these guys that are writing the checks they've already gone through the process once or twice in your industry. They know exactly what's around the corner. And so they know exactly how to best guide the company from a capital provision perspective. Everybody else, the other 85% of the universe of these 12,000 private equity, you shouldn't even talk to, because they just have money. They're smart people that have money. Smart people that have money are ubiquitous. That's not if what you're looking for is just money and not that expertise, the private equity or the ESOP transaction is far better, because you get the same amount of money and you don't have to pay tax. There's better solution. Or maybe you're better off just selling to a public company. If between you and the Lord, you sense that the Lord's telling you that you need to be out of that business from a business risk perspective, and I think that's a real possibility. That's between you and the Lord. Who am I to say that doesn't exist? Then maybe the best answer is to not sell to private equity at all. It's to sell it to a public company, get all cash, shift all of the business risk immediately to that third party buyer, get that cash, and go do with that cash what the Lord's telling you to do. So I think those are, I know you didn't specifically ask this question, Josh, but when you choose to sell to what party is a function of what you're trying to solve for, I would say, in your quiet time. Now, can you get the same benefits, relational benefits, industry benefits, consulting benefits in this structure that you can get from a private equity group? The answer is yes. We, as our general partnership, have a broad experience both operationally and as advisors in multiple industries. And so do we have every industry covered? No, nobody does. But I think you can sustain the same level of what you would hope in this structure. Yes. And you get to again control your own board, which means you get to pick, rather than private equity guys going on your board and controlling it, you get to retain control of your board, and you get to pick who your independent minority, meaning fewer seats than the majority of your board are, so you can help yourself by picking the right board members and do it in a way where you're not giving up control.
That's excellent. So I know probably one of the things that people will have a question about. In fact, Josh actually had a follow-up question there about that. about this, but just the best thing to do is to likely get in touch with you and have a follow-up conversation with you following this webinar, which the email that's going to come out to you, folks that have registered for our webinar here today, you'll be getting that information. There'll be a QR code in the email that you can scan that will take you right to a contact submission form. And I know that Perpetuate Capital will be looking forward to following up with you and having some more conversation there. So, yes. Anything else that, I mean, I know there was some other information, Brandt, that's in the emails going out, some things that you had supplied. You want to chat a little bit about some of that, what we're sending out?
Um,
The video, by the way, I watched the video, of course, that you had
I remember
supplied.
what I sent
Excellent.
you. Yeah,
That was great. Yeah, I knew. I was like,
yeah.
you probably doesn't remember, but yeah,
But
it was great. Yeah.
that's like a 5-minute video where I'm on a whiteboard and
Yeah.
I'm just
Just,
saying, here's super high level. Here's what selling to the private equity group. Here's what selling to the club looks like. It's like a faster, perhaps more elegant version of what I did up front.
but yeah, it'd be a great way to just kind of go back and see that
And send it,
again. Yeah.
yeah, send it to your partner, send it to
Yep.
people. It's a good
Sure.
way. It's a good on
Mhm.
ramp.
Yeah.
Uh, I wrote a book. My first book was called the ESOP Playbook.
Okay.
I don't think I sent that to you, by the way.
No, I know.
Available on
Okay.
Amazon. If somebody sends me an email, I'm happy to not bug them and spam them, but I'll send them a free PDF of that book. It's written for CPAs and lawyers. It's very easy to read,
Go
but
ahead and pop that up while you're chatting. Go ahead.
it's not. It's a technical primer that takes complex stuff and makes it a lot way simpler to understand. And then beyond that outlook, look out rather for my second book. It's called Perpetuate: How to Selling Your Business Without Selling Out. That's about to come out, I think, either in December or January, and happy to send you guys free copies of that too. But it hasn't launched yet. It's a story, by the way, of a business owner in FCCI and a business owner in Vistage.
Mm-hmm.
They both get private equity offers, and it's a narrative story of how they dealt with their decision making in
Gotcha.
their groups, and then
Mm-hmm.
and kind of takes it beyond that.
Oh, that's great.
So less technical.
Sure, sure. No, that's great. I love that. I love that story format. There is a question here about is this video, the recording of this webinar going to be available? Yes. The same link for YouTube will continue to be active and evergreen there on YouTube, so you can come back and watch this at any time. If you're having bandwidth issues or want to be able to share this, you can definitely do that. So, well, Brandt, thank you. This has been outstanding, just a wealth of great information. I really appreciate you taking the time and sharing that with us. So,
Happy to do it. I'll leave you with this last thought, which is you are a steward of the business, whether you know it or not. You are a steward of the business. And I think as a steward, you owe it to everyone to at least do 4 or 5 hours of homework to understand this alternative so that you can pray in a more informed way about doing it. It doesn't mean it's right or wrong. It doesn't mean that you have to go do this. I feel like
just
you
be
do
informed.
need to, yeah, you need to inform yourself.
Sure.
as a
That's
steward.
great. I love it. Okay, good.
Bless you guys.
Well, thank you again. And folks, remember, we do have a webinar next month. You'll be getting an email shortly that will give you some information and registration link and follow up from this webinar here today. So thank you so much for joining us. We'll look forward to seeing you next time.